Hi, good morning, everyone. On behalf of Axis Mutual Fund, I would like to wish all of you a very, very happy Mahashivratri. I think these are very dark times. The world has suddenly been plunged into, again, massive uncertainty. There seems to be something about the months of February and March. I don't know, many of you will yet recollect about 2 years back, we had a similar issue with COVID. And that was the first time in about 100 years where the we went into a pandemic stage and the world was really grappling with it. And just when we thought that things are getting better and vaccination is happening and people are slowly coming back to normal, I think this happened. So yes, I guess I think part of our life is prayer. Today is a good day to do that. So again, thank you very much for all the 500 odd people who are watching me right now. I think when people ask me what is the big difference between uh, my when I started life in 1998 uh, and where I am today in the mutual fund industry, I think, and I keep saying this, I think the big difference is that investors are much, much more clued on to what is happening. And more importantly, they are very, very keen to try and get uh, more knowledge, either by participating in such webinars or asking questions or getting into chats. And I think that is a big difference. Today, I think we are in an age of the informed investor. 22, 23 years back when I started, most investors would just put it on the basis of someone saying it's a great fund, wow, वो बहुत अच्छा fund है, बहुत अच्छा return है, बहुत अच्छा brand है, बहुत अच्छा नाम है. Today people are not like that. I think people are very, very, very different. At Axis, thanks to all of you, we are now almost 1.2 crore folios. That makes us amongst the top five in terms of retail investors. And we run a very, very good small cap managed fund and Axis small cap fund. It's almost like $1 billion plus 9,000, about almost a 9,000 crore fund. In fact, we've actually stopped taking lump sum money in that. We've put some gates in it to basically avoid people coming into trade. Right? So many people have asked me, and I'm going to take this question upfront: that why is Axis launching a Nifty small cap fund right now when there is already an Axis small cap fund available? Now, I think clearly there are two types of investors. I think there are people like me who are a bit lazy, who are happy to spend their holidays doing things like what I'm doing right now. But there are a set of people who are obviously very happy to be more hands-on, more active with their investments. And I think in some sense, as a manufacturer and as a premier financial services provider, it's our job to make sure that we give people choices. So what we have done, however, what is our contribution to this product is to just try and filter out and make this index a little more safe for all of you who want to invest in it. Otherwise, frankly, it's a very passive fund and there's really nothing that we contribute to in terms of stock picking, right? So on that note, what I plan to do today is take you through over the next 20, 25 minutes, maybe 30 minutes if you allow me to just what's the basic story on small caps, what do they do, what are small caps, what are the risks, rewards, more importantly, what are the sector, and then we just spend a quick 5 minutes on this product because there's really nothing much to talk about in this fund. It's a very, very it's, as I said, it's a passive fund, right? So on that note, yes, I have my colleague with me, Shoaib. We're going to do this together. Shoaib, can we go to the next slide, please?
Sure.
This is our disclaimer. I think just let's go back, Shoaib, for a minute. I think it's important. I think as you can see, the benchmark riskometer, and this is very important, and I urge all of you to please look at this whenever you're investing. I think the regulator has done something very, very good as disclosure requirements for investors. But I think ultimately we can put all the disclosure that we want, but ultimately as an investor or as a prospective investor, you must look at it carefully. So you can see this has got a high risk. It's a very high risk rating because of the nature of the product that is there, right? So on that ominous note, now many of you will be thinking, is Raghav actually talking about buying this fund or selling this fund? I think that's not the case. I think, as I said, it's my job to put these things on in view to you. And then ultimately, as an investor, you have to figure out either through yourself or with your partner or with your advisor whether you would like to really put some money into this space at all. Yeah, next please. So I think clearly, when you look at, there are three basically big. Forgive my throat. I'm having a little bit of a sore throat. I'm actually sitting in Bombay right now, and I think Bombay goes through this weird transition in February, March, where I think suddenly it goes from cold to hot, and then for some period of time it goes back to cold again. So sorry, I seem to have got a throat. Many of you ask me what is small cap. I mean, small cap is nothing but there are three essentially market segments in the system, right? And I think all of you know this. Uh, there is the obviously the large cap segment, which is essentially India's top 100 companies, right? Uh, these are companies who are typically having a market capitalization of more than uh, 30,000, right? These are typically the names that you would read, see, hear almost on a daily basis, right? The Infosys, the Tata consultancies, the Wipros, the Tata Steel, these are all coming here. Then, of course, you have the mid-cap companies. These are interesting companies who are from the 101st company to the 250th. Now, these are company categorizations defined by the market regulator, which is SEBI, right? And this typically are in the range of about 10,000 crore market capitalization to 30,000 crore market capitalization. And the last one is typically the small cap. It's typically the 251st onwards to possibly onwards from there. And you know, India is a massive, we have almost about over 6,000 companies listed in our exchanges. So it's essentially 251 all the way down to 6,000. So market cap is again for people who are novices or people who have never heard this name, because sometimes for people like us, we hear this so often. Market cap is nothing but the number of outstanding shares issued by a company multiplied by its daily stock price. And the price is, as you know, fluctuates every day. That's available on the exchange. Right. Next, please. Sure. So typically, this is a very no-brainer slide. I think obviously the large cap companies are well-established businesses. They dominate their industry. Typically, they'll be top 2, 3, 4 in their market segment, and obviously because they are dominant, they are large, they have brands. They have large balance sheets. They have ability to withstand risk, shock. They are typically, the share prices are much lesser volatile and obviously very liquid. What I mean by liquid means that if you have, let's say, if you want to tomorrow sell 100,000 shares or maybe even 1 million shares of, let's say, Reliance Industries, it can get sold very, very rapidly without much effect in the price. It will just go at what we call on screen, right? Mid-sized companies are in some sense a transition. They're just companies which are yet getting established. There are many large cap companies which are mid-cap companies. That's the flip side of being a large cap. If you don't maintain leadership, you quickly lose your share price, and then obviously you fall down in terms of market capitalization. They have normally higher growth prospects, obviously because they're smaller, they are nimble, and but they are much more volatile, and yet, but of course, they are reasonably liquid. Now, small cap is obviously the highest risk segment, right? But there's huge growth here, so this is where you will see emerging industries coming in, and just to give you a sense, about 10 odd years back, when many Indian entrepreneurs saw a massive opportunity in chemicals, right? And fine chemicals are being used for a lot of things. Now, chemicals, when you and I think about it, we think about these huge, massive chemical factories doing black smoke out. It's not like that. I think chemicals are now used in just about everything, from as small things as your mobile phone screen cover to large, obviously space shuttles, rockets, and stuff like that. And, many entrepreneurs saw that as a big opportunity, and they got into it. And obviously, some of them have really done well, and obviously done extremely well in terms of the stock price. In fact, one or two of them have even graduated to become large caps. The other one, of course, is I keep talking about my favorite example in terms of pharmaceuticals. Many 30, 35 years back, many of the pharma companies that you see today started off as contract manufacturing companies. And slowly over the period of time, thanks to promoter involvement, thanks to second generation, thanks to just getting great collaborations, they just went up the curve and became mid cap. And of course, there are a few large cap, right? So obviously they are very volatile because obviously they don't have the ability to withstand shock. Small market movements can damage them, especially things that have happened to Indian economy last 5 6 years. Starting with demon, GST, the NBFC crisis, which led to a bit of a funding crunch, and then of course the last 2 years being COVID. It's been a tough time for entrepreneurs specifically, and more importantly for small cap companies. So obviously very high risk in that sense, but obviously given the fact that some of them who are able to break out and who are able to do things like really get into niche areas and really grow those areas, they really take off. And some of the new age companies that we are seeing today all started very small. And of course it's not a good thing to talk about the Paytms and Zomatos because obviously they're getting bad press because of their stock price. But many of these companies would essentially fit into the small cap definition 10, 15 years back when they started life. Right? Next please. So essentially key characteristics, as I said, large cap 100, 1 to 100, mid cap 101 to 250, small cap 251. Just look at the traded volume. This is what I talked about liquidity. Every day, on a 6-month basis, these stocks trade about 37,000 crores. That's the average traded volume. Obviously, if you take some of the larger names, many times that volume. Mid cap is about 16,800, which is what I said, anything between 10,000 to 30,000. And small cap, as I said, is anything sub 10,000, so about 8,000. This is their average traded volume of the entire company's. So, as you can see, because it's a free float, is the number of shares available for trading. Obviously, large cap are the highest. Market cap, no guesses there. Obviously, large cap dominates. Mid cap, of course, is interesting. And this is the last part is critical because many people ask me, hey, but these companies, they don't, the last, especially in the last 45, 50 days, many of these companies have not fallen as much as some of our large cap companies, right? And that's because of the fact that especially over the last 4 months, November, December, January, Feb, you've seen a massive amount of FI selling. That's largely happened because I think it started with the US Fed starting to normalize rates, which obviously led to a little bit of a risk off what we call, we are in some sense, India is for us obviously the biggest market. It is the only market, but in worldwide terms, we just contribute about 2-3%. So in some sense, India is the small cap of the world. If I may give you that example. Obviously, there was this huge pull-out of emerging markets, but you look at the FI holding in small caps, it's very, very small. That's largely because of two things. I think one is governance, and number two, most importantly for them, is liquidity. Because obviously, when large foreign institutional investors come in, they want to have an ability to enter and exit without causing too much damage or reaction to the stock price. Sectors, of course, it's very, very diversified, but obviously the large cap dominates the banks, auto, and obviously conglomerates, right, which are combination of various things. L&T, for example, is a conglomerate. Reliance is a conglomerate. So things like that. Obviously, in the small cap space, as I said, chemicals, small consumer durables. Typically, as you can see, these are very, very, very promoter driven. Textiles. Some of these are really, really there. Of course, in the mid cap space, you have just about a mix of both of them, right? Next, please. So very clearly, what is a small cap stock? I mean, if you were to look at it, very, very potential high growth companies, they're very promoter driven. That's the key thing here. I think if you have a very good promoter or a set of promoters, if you have good collaboration, very, very, it's essentially very top down driven. I mean, these are not your process driven setups, right? I mean, I'm not saying the promoter is not process driven, but they are very, very nimble, right? They're reasonably niche, and they want to try and disrupt what we call the status quo. Because what I mean by status quo is that there is certain market environment for a product. I think obviously, as I said, dominated by 3, 4, 5 people, and you will find a smart promoter coming in. Obviously, nowadays backed by equity capital, maybe has a good idea, possibly a technocrat, and then they just sort of try and disrupt the existing business, right? And obviously, very scalable. Chemicals is a classic case. It started off for domestic consumption. Today, many Indian companies are amongst their top. They contribute a lot to exports over here because they supply to some of the world's largest things. I mean, about 20, 25 years back, I don't know how many of you were watching this are from the south, but again, huge amount of businesses over there from the autocom space. So again, similar thing. I think they started off small. They started supplying local, started disrupting some of the existing businesses. But over a period of time, they got so good at it that it's become really, really large. So things like Sundaram Fasteners and things like that. They are very massive companies who were started small, but today are in a bit of a global. They're amongst the largest global suppliers to many of the best and biggest auto companies, right? And I said, it's a high risk, high reward quotient. So you have to be reasonably careful when you get into it. I mean, this is the key feature of small cap, which is one reason why many people don't get into small cap because they just can't handle the volatility. Because you could see massive drawdowns and massive increases. So obviously, when it increases or stock price goes up, everybody feels happy. But obviously, when it comes down, and especially if you're not tracking the company at all and you don't know why something is falling the way it's falling, it sort of sometimes makes you panic. And that's a combination of various things which we'll talk about in the next 5-10 minutes. Yeah, sure. So I think clearly I think what we've tried to do is you need to be very, very picky with small caps. So this is the reason why where we come in and try and put in our two bits to try and figure out how to make the index a little easier and a little better for you. So I think key things that we look at in Axis, and as I said, we run reasonably large small cap fund which has given a very, very good investor experience to investors over the long term, right? So I think for first thing that we obviously like to see is the promoter pedigree, because I think what is the promoter, what skin in the game does he have? Has he been selling, buying? Has he pledged a lot of his stock? Does he have interest in other industries? Is this just, or this is his mainline business? So all those things come into corporate governance. Obviously, we look at execution. That's very important because we are in a presentation world. Very easy to make a presentation today, but very, very difficult to go out and execute it. And then, of course, our key features, which is essentially the things that Axis looks at, is obviously ROE, which is what is the return on equity is giving. And then obviously the biggest important thing is what is the return on capital employed. So capital employed is nothing but equity plus, let's say, long-term loans. If you put that together, you get a number, right? And more importantly, I think from a scalability perspective, is it something that somebody's just coming to take advantage of an immediate idea? Like let's say maybe 15 years back, there was this huge thing in Bombay. Slum rehabilitation was a very big thing. So every Tom, Dick, and Harry builder got in and tried to get into slum rehabilitation. It had all its usual complications because you have to be part of the government. You have to you have to vacate a lot of existing slum dwellers. And obviously, when you get the payback is very, very large. But it's clearly not like it's not a multi-year growth model. Those were tactical projects. They just got some land and then moved it up. So those are things that we will not look at. So I mean, is it something that can be there forever? That's what we're trying to see. And I think more importantly, I think key thing for us it will give you a sustainable return with slightly lower volatility. That means how do you measure volatility? I mean, basically you see obviously the movement in stock price between high and low is the immediate barometer. But for us, I think someone who's got good cash flow, who's got good cash in hand, and that helps you to withstand event shocks. When you're able to do that, automatically you become a little less volatile, right? And obviously, balance sheet is critical to us. So I think balance sheet, as I said, what the balance sheet hides and is if you look at a balance sheet, my advice to people over here is go backwards, start looking at the notes to accounts, and then see whether the balance sheet is sound. Does it have any contingent liabilities? Is there a lot of litigation? Those are small things that comes out in the balance sheet today. So that's another great thing that the regulator has done. I think given by putting pressure on and the exchanges have put pressure on companies who are listed there. So the amount of information which is available in public domain is reasonably interesting. So we can all watch these Harshad Mehta serials and Ketan Parekh serials, and they are very nice and gripping. But the fact of life is that we've had nothing, and touch wood, we've had no serious scam in the last 21, 22 years. I mean, the last big one that I remember was 2000, 2001. After that, yes, we had a lot of small problems. The many brokers getting into default and things, but like a really big thing which has happened and blown up, I don't think that's the case. And that's largely to the credit of the regulator because they made things very, very transparent. It's very easy for people who want to get information to get it. So all this stuff which I'm talking about is all available in the public domain. Obviously, we put it through our filters, we look at it, and then based on what results come out, we invest it. Yeah, next one. So I think this is the big one which all of you should look at because many of us look at the last 1 year return, right? And this is the key thing. Don't look at 1 year because different markets give you different results. So when you look at, for example, let's go back and see, and I don't know if my slide is visible, but if you go back and see in a December 03 to Jan 08, which was the last big boom period, not just in the last decade. That 5 year period, small caps really bashed up large caps. It was like a 55% rise vis-a-vis a 36 to 40% in mid cap, right? But just look at the next year. I mean, in that 1 year, it was Jan 8 to October 8, which is possibly one of the worst periods in the market. Many of you may not remember it because it was 14 years back, but that was the global financial crisis. It was a very terrifying moment at that point of time. But their small caps fell 80%. Now that's a crazy number. I mean, just think about that. And now let's go back to, again, if you go back to October 19 to March 20, and I told you, we've had not exactly a recession, but we've had a tough challenge all the way from Jan 18, when GST came in, and prior to that, demon. And obviously, these are shocks or adjustments which the larger companies are able to manipulate or maneuver very, very easily. Uh, Smaller companies take time. So let's look at Jan 18 to October 18 was a very narrow market. Nothing happened. So you see, large caps hardly did nothing. I mean, they were just in and out on -4%. But just look at small caps; they got bashed up again, -27%. And just look at again October 19 to March 20, same problem. Again, you had a massive fall in the market, if you remember at that time. And again, small caps fell like 62%, the service of 49% movement in large caps. So what we're trying to say is, and this last 1 year, I mean, this is the big one. Everyone looks only at this number, right? March 2020 to September. So everyone looks at the small cap index and says, hey, this is like 100% return. I have to participate in it. So I'm not saying don't participate in it. Don't participate in it because of giving just by seeing the last 1 year or 2 year return. That is that'll be a bit foolhardy. That'll be a bit risky, right? Participate in it because you believe in the entire small cap story. You believe in the fact that small companies can get large. You believe that a junior setup can a small company is more nimble, and more importantly, that India is a growth market. So over a period of time, we are in some sense a micro market. I mean, if you look at the number of entrepreneurs that are doing interesting stuff today, it's absolutely crazy. And I used to think it used to be focused only in Bangalore or Gurgaon or the typical startup hubs. Of course, they are obviously very, very large flag bearers of that. But if you go to any mid-sized town in India today, we are in some sense a country of entrepreneurs. And so an entrepreneur ultimately will become a small cap, right? And then if he does really well, he'll become a large cap. And that is where I think you need to be a bit careful. So my view in life is that yeah, it's better to allow a formula to do it or to allow a fund manager to do it. I mean, unless you have the time and the ability to sift through all that data which is available in the public domain and then make your investment thesis and obviously put money in. So don't go by this is an important slide. Just stare at it for a couple of minutes more, or a couple of maybe 10 seconds more. Just look at the way the return just fluctuates a bit. Yeah. Next slide, please. Sure. So I think if you see the when markets tend to do very well, like we had a situation where pre-COVID, I think the market was very, very narrow. Very few stocks gave a bulk of the returns. And I think that's a narrow in a broad-based condition when many stocks are doing very well. That's the time you see that small caps really, really do well. And this is where I think if you see the red line is actually the Nifty TRI, which is the top 50 companies, and this is the Nifty Small Cap 50 TRI, which is the index that we are coming up with. And you see the kind of from Jan 2020 was actually in some sense the bottom because that's when COVID just started showing his ugly head, and then March was really bad, and then you see the kind of movement which has happened after that. And small caps have done really well. But if you look at again the same thing, if you go back and see maybe 3-4 years back, there was a point of time where the index was doing extremely well. This is just after the elections, the second round of elections which happened, and markets were just coming back into flavor. This is just after demon, and things started again was a little broad based. So I think in broad based times, that is when many in the overall economy is doing well, is obviously when small caps come into play a lot. Yeah. So that's the theory that's there now in the market. The China plus one theory, the Atmanivesh theory, the Gati Shakti theory. These are all things which are there, and we are seeing a huge amount of money getting into investments, into infrastructure investment, and a lot of money getting into growth. And clearly, I think the government is clearly working on making life much easier for companies to set up, to grow, and trying to cut out all the red tape. I mean, we have some distance to go, but I think it's a massive step in the right direction. So if you are a believer that the next 5-10 years are going to be a great India theme story, I think then obviously you cannot avoid having small caps in your allocation if you want to really give it a good boost. Next, please. So I think, like I said, I think the post-recovery things have really taken off. I think, as I said, post-COVID, what happened in COVID? I think if for the first month or so there was a massive shock, the economy got frozen. All of us know we got frozen in some sense. Somebody literally came and said statue to us, and but after that things started, sort of uh, uh, uncalculating and sort of unfreezing. And RBI pumped in huge amounts of liquidity. That was a global coordinated action. You know what's happening. And in that period of time, many of the companies, the economy started suddenly sputtering back to life. And you can clearly see that happening right now. So if you look at, especially the last 1 year, has been a period where small cap stocks have really outperformed their large cap. Right. I think there's been a lot of investor interest. There's been a lot of balance sheet cleanup. Uh, there's been some amount of revitalization of demands. All that has helped to take it up further. Right. Next, please. So this is the same slide that we've tried to put out in the first as a chart. I think if you go back and look at, for example, I told you 2008 was like a really bad year for the stock markets in general. That was a down cycle because of the GFC. You see, the large cap index was down 50%, while the small cap index was down 80%. And 2009 again was a massive recovery. If you remember, again, the same thing in some sense, which happened in 2020. Central banks came in, pumped a lot of liquidity, essentially put a lot of more money into the system, tried to get the entire blood flow going again of the world economy. And you see what happened there. Again, markets did very well in that period, but yeah, there was a move of 70% in the large cap and almost 110% here. So in some sense, that is a parallel of 2009 and to some extent 2021. There is massive outperformance there. Both 2020, 21, you had 2 years where the small cap indexes have actually done very, very well vis-a-vis their large cap their large cap peers, right? So I think the key question that we all will have to ask ourselves that what is going to be the next 3-5 year return, right? I think the fact is that we are in a growth cycle. Uh, we are in a very interesting place. I don't know how the war will pan out, and obviously we have a few questions from some of our audience already. I have put it in, so I'll try and answer it during the Q&A. But the fact is that India is in a great what we call a unique growth cycle phase. I think this, in some sense, is many people who are uh, die-hard. I won't say anti-India, but let us say people who are a little cynical are even today coming back and saying like this decade will be a great decade for India. And this is irrespective of what happens in the political space. I mean, if you have change in political guard, that might slow down. It may be 2 steps forward, 1 step backward situation. If it continues as it is, it may just be a 4 step forward situation because then it's everybody knows what to do, right? So obviously those risks are there. What's going to happen in Ukraine? What's going to happen politically? What's going to happen with the U.S. Fed? Those are all to our mind slightly. They are bumps. But ultimately, nothing can take away the fact that Indian companies are today on a very very solid growth path. The economy is on a solid growth path. We do have a good demographic dividend, which we will be able to sustain for the next couple of decades at least. I think starting 2035, 40 is when Indian population will also start showing some effects of aging. So we have a great 10, 15, 16-year runway in front of us. And obviously we have this whole $5 trillion aim that we want to get to. All that, if you put it together, I think it is essentially a great pro stock or a pro equity story. Now within that equity, you will have to really figure out whether you want to be in the higher risk element, which is small cap, especially given the last 1 year to 3 year performance, or do you want to sort of stay and be in the large cap? Now, that is something that I think is something that is individual to you, dear investor. It is something which I will not be able to give advice on a family because even every investor is unique. Every investor has a different risk profile. So the best way to do that is to talk to an advisor or take help of an expert and then sort of just do your finances and try and figure out how much you can. My thumb rule for investing in small cap is that is it money I can forget about for the next 10 years? And ideally, I like to put it away for 5 years. Minimum, I tell people is that if you don't have 5 year money, don't come into small cap because, as I said, the volatility can really be quite frightening for everyone, especially people who are looking with a 1 year track record in the background and saying, hey, this last 1 year index has given me whatever 30%. So I will get 30% next year. There is no guarantee of that. Right? Next, please. So this is a very interesting slide, and if you look at it, this just shows why you need to be careful across market capitalization, right? And if you look at this is the top 500 companies in the Indian economy. Obviously, as I said, the top 100, then the next 150, and then the balance 250. And if I'll start from the top now. Out of the 100 companies that were there 10 years back, only 52 companies continue to be large cap. In fact, 33 companies have actually got downgraded. That means their market prices have fallen. and 10 companies have become small cap. That means roughly their value has gone down by one third. And of course, 5 have either got demerged or acquired or maybe just delisted out, right? Now, if you go to the small cap space, and the same thing is there on the mid cap side. So you look at 150 companies, only 37 continue to be mid cap. Out of the 150, only 22 went up, which is hardly maybe 15, 16% of the total universe. And actually, more than four times that, three times that number actually came down. So again, shows you the value of why you need to have a bit of a rule-based investing, or you need to be a little more judicious in your investments over here. Because just by investing on the back of some some recommendation made in media or something that you read, you have to be very, very, very thorough about why you're buying a particular stock. And small cap is actually very frightening because out of the 250 stocks, 200 are continuing to be small caps, means nothing happened to them. 35 actually went down. So they actually moved out. Now, God forbid, you were already in a high risk element. Now, if you were, let's say, if you were in those 20 or 10 companies and you had money there, effectively your money is gone. And only 11 companies moved one level up, and only two companies became large cap. That just shows you the element of how difficult it is and how careful one needs to be to select the right stock. Right. Next, please. So I think what do we do? I mean, essentially there are two risks. Obviously, one is the risk of non-performing businesses across all segments, whether it is large cap, small cap, mid cap, and of course, liquidity is a big problem because I think in a large cap, even if you make a mistake, I think given the fact that you have a lot of floating stock, it's easy for you to rectify that mistake by just jumping out and moving on to something else. I think the key thing that we have done is that I think in this index is to focus on the liquidity, right? We obviously would like to give if you have, so one of the ways we look at small cap, and this is a very important part of our the way we our screening process is what is the more liquid stocks. And obviously, liquidity allows you to flexibility of getting in, getting out. Obviously, it gives you non-better. You have lesser promoter ownership. So sometimes, if you have very high promoter ownerships, it is subject to sometimes manipulation, etc., which is difficult then for an institution to get into. If you have non-promoter institution held by a large set of people, obviously demonstrates that many more people are interested in owning that company. So obviously it's got better practices, etc. And then of course for us, I think very clearly if you're below the in the top 250, if you come below 130 for whatever reason, automatically you just get knocked off. So we just essentially weed you out of it. So yeah, there is a 250 index, there is a 150 index. I think we brought it down to like a 50 stock index, which we think is a good place to be in because you're essentially buying the most liquid and hopefully the better management in the index at all. Yeah. Next one. So I think this is the Nifty 50 small cap. I think very clearly we've picked the top 50 companies on the basis of turnover from the top 100, right? So I think very clearly we look at the entire free float mechanism, which is free float is what is available in the market to trade rather than just taking a total market cap, right? And this index obviously keeps getting rebalanced on a biannual, which is every 6 month basis. So it's not static. It's not that you buy it today and then the same set of companies are going to be there for life. No, I think the Nifty has a committee by which it sort of keeps looking at it depending on the rules that we've set, especially on the turnover. So you can see it's a very well diversified index. Even though financial services are 35%, the banking element to the financial services space is much less. So it has more, obviously, as you can see, more weightage to exchanges. It's got more weightage to registrar companies like CAMS and things like maybe an IDFC and other housing finance companies too. Correct. So I think that's the key thing. And obviously you can see it's reasonably well diversified. And obviously these things keep getting rechanged, recharged every 6 months. Yeah. Next, please. So I think just to sort of refresh why we want to put money into an index fund, I think very clearly rule based because really the fund manager has no role to play in the buying, selling. I think in terms of the stock selection, there are a set of rules which are there. Largely in our case, obviously the liquidity rule. It's very consistent. You know what you're getting into because you have a churn every 6 months. Because whenever the index looks at it, that's when the stocks get included or excluded. That's when it's very, very low. You don't have to worry about too much of turnover. And obviously, it's market linked because you're essentially buying an index, right? There are a set of investors who say that, hey, we would like to we like small cap, but we don't want to get into an actively managed portfolio because we'd like to take control of our own investment process. And in some sense, this fund is for that. And many people would like to just come in because of, they just want to come in for trading. which is fine. I mean, because this fund, because it's very very liquid, doesn't even have an exit load, and they're not very clear about what alpha fund manager creates. Now, people ask me which is better: is it index better or is it actively managed? I think it's not an or decision. I think it's an and decision. You must have a bit of both. I am a traditionalist in some sense. I believe that India is a great fund manager alpha market. But yes, I do have a little bit of personal money into index funds also because of the four things that I mentioned. I think it's market linked. And one thing which obviously, which everyone knows, we've not highlighted, is the fact that these are much lower cost as compared to a regular actively managed fund. Right. Next, please. So I think this is the last part, this last simple slide. I think obviously the person who manages this is our head of equities, Dinesh. And as I said, there's no exit load. Its benchmark is that Nifty TRI index, and it's a 5,000 rupee and one thing in line with the entire market. The NFO is on right now. Closes very shortly. We'll hope to reopen it. One reason why, again, to come back and just close this as to why Axis is doing this launch, I think it's important. There are various sets of customers. Customer preferences are, our job is to make sure that we give investors in our opinion, the best experience either in our actively managed fund, which we've done very well, and obviously in the passively managed fund, what we've tried to do is add some more risk control into it in the way that index is designed, and more importantly, so that we try and avoid the pitfalls of the small cap investing. Right. So thank you again for joining us on a holiday. I'm really grateful to all of you. We have a huge number of people on this call, and now in excess of about 400 people. I think 500 people if I can see my WhatsApps on my here, but I think it's much more than that. But more than the number of people, I think the fact that I think a lot of you have come to us with questions, and I hope to take some of them because I know it's a holiday, so I don't want to sort of drag this on for more than another 15-20 minutes maximum. So I'll let you get out and enjoy the rest of the holiday. So thank you again on behalf of Axis Mutual Fund for joining us today. Yeah, sure, we're happy to take questions.
Yes, sir. There are actually lots of questions. So the first question is, Axis, why to invest in Axis Nifty Small Cap 50 Index, whereas Nifty Small Cap 250 Index option is also available?
It's a good question. I think because the 251 is a little more popular as an index. I think we have 3 or 4 schemes already there. Like I said, I think for us, I know I showed you that table, if you remember, 251 to 500. And if you remember, only about 10 or 11 stocks actually went up the curve into mid cap and large cap. And actually 70 odd stocks or 80 odd stocks, if I remember correctly, that number actually fell below even the index. So I think clearly quality is very important. One determinant of quality is liquidity. So that's how we've used liquidity as a parameter and tried to select the top 50 liquid stocks, especially in free float capitalization for you. So how do you determine quality, and how do you determine quality by the number of investors? Non-promoter investors are also there. So that's been a big barometer or a big tool for us to crystallize that. So as I said, it's you don't need to be in 200 companies. Like I said, the 250 companies, only 13, 14 companies actually went up. Our job as investment manager is to try and make sure that we place our index in some of those companies which are able to graduate up the capitalization curve rather than go down. So just by being in 250 stocks, yeah, you have more diversification. That's true. Number two, it's also very difficult to execute. Many of these companies, if you look at, let's say, the 200 stock and the 250 stock portfolio, doesn't have any turnover. So let's say hypothetically, I get a lot of money. One way to make sure that my index or the Axis small cap index is an efficient index is the tracking error. The tracking error is nothing but the NAV of our fund vis-a-vis the movement of the index. The lower the tracking error, the more efficient is this for all of you, right? That sometimes is difficult to do when you're looking at a 250 stock portfolio because there is no liquidity available in many of those stocks. So sometimes we just have to just keep the money cash, or that's the other also big reason.
So the next question is, will market become more efficient in small cap sector in the next 10 to 15 years?
I think, as I said, India is a massive entrepreneur market. So my view is you'll have a constant stream of companies who will go from micro cap, and it's in some sense it's a bit of a bit of a cycle, right? People start, and today there's a lot of uh, venture capital funding, right? So ultimate aim of a venture cap or a company is to get themselves small, get initially, and many of you are entrepreneurs. You know this better than me who are watching. You start with family, friends, and then you get some external funding. Then you get more external funding. If you have a really good idea, you come into the small cap index, and then if you do really well, you go up the curve and get into mid cap and large cap. And that's there are some names obviously which are there. I mean, and they are obviously more in the startup space today. But I'm sure, given the broad basing of the Indian economy, you will see a lot of names even coming on the manufacturing and the other side also. So I think yes, it will become efficient. But yeah, so hence the pipeline of companies will constantly keep coming in. The key thing is, like I keep telling all of you, is to ensure that you are in the right company at the right time. In fact, timing is not a problem. If you're in the right company, even if you buy it at a slightly higher price and the company does well, it will justify your valuation at some point. But if you're in the wrong company, like I said, out of that 250, God forbid, you are in that 68 or 80 companies which have gone down, then you have a problem. Then you have a really big problem.
Another question is one of the gentlemen is asking, should I invest in Axis Small Cap Fund or the Axis Nifty Small Cap 50 Index?
That's a good question. So I think that again depends on your risk profile, because I think that's a question I'll rather leave you with to ask your partner or your advisor, because I think they would have a better sense of your risk taking ability. But as I said, for me, it is an and decision. So yeah, something which I can put away. So I would put away small cap Nifty TRI for 5 years, and I would put Access Small Cap Fund for at least a 10-year period. So at least that's the way. At least internally in my mind, I will try and differentiate between the two investments. Yeah, but both are high quality investments. Obviously, one has lower churn, a much lower expense ratio. But apart from that, the Access Small Cap Fund also is actually a fairly low churn fund in some sense. It's more of a buy and hold portfolio, and there is a fair amount of active bias with all the filters that I spoke to you about. So what we try to do in the Axis Small Cap Nifty is to try and take some of our experiences of running the small cap fund, especially the challenges that we face there. And liquidity, as I said, is a big challenge, and quality of ownership is a big quality of companies is a big challenge. So we try to take that and use our experience there to sort of work on this index for you.
So we have a question, what percentage allocation should be done to small cap, mid cap and large cap and focused funds as well?
Oh, that's a tough one. I can't answer that. So again, I'm sorry, I'm going to sound like a stuck record, but I think again, a question that you should be asking and talking to your financial partner or your advisor. Because as I said, I have really no idea of your risk element, and maybe if you could mail it to us separately, we'll try and put some filters in it and try and get it back to you. But something I cannot talk about, because typically the equity allocation, and this is the old, I think I call it the lazy definition, because this is the 100 minus your age, right? So if you're a people say if you're a 50-year-old guy like me, then you will have to have 50% of your allocation in equities. But I can share from my personal experience, I have much more than that in equities, because my risk taking ability is possibly much higher than maybe the person who invented that 100 minus age formula. So that's the point I'm trying to make, that every individual is unique, every investment decision is unique. So it's better there. I can only put one thumb rule for you. Obviously, uh, given that large cap stocks are lesser volatile and more liquid, I think your tenures can be shorter. And of course, given that small cap stocks are a little less liquid, more volatile, it takes time for the growth story to play out. It's not something which can turn around in 3, 6, 9, 12 months. Maybe it requires time for that whole journey to play out. You should have a slightly longer term investment horizon when you're looking at mid cap and large cap. I mean, and small cap.
Okay, one gentleman has actually been convinced. He has said that he is going to invest into Nifty Small Cap 50 Index Fund.
Thank you.
Uh,
Thank you.
how much should he invest?
No, I'm sorry. Again, stuck record, not again something in my domain. Yeah. So again, yeah, it depends on your this thing. Don't go overboard. My request is many people have gone overboard in small cap funds, especially in the last 3, 4 months, right? Looking at last 1.5 years, the returns, our industry is that way a very funny industry. I think people run away when markets come down. So, I mean, there's an old saying that I have heard that whenever there's a sale in any other industry, people queue up. I mean, 3 days back, I was returning back from an event and about 10:30 in the night, and I saw this huge crowd outside the Adidas showroom near to where I stay. And I was wondering what the hell is happening at 10:30 in the night. Then I realized there's a big board show which talks about some 35% sale, but available only from 10 p.m. to some 12 p.m. or something like that. So, people are happy to give up their sleep or whatever and sort of stand in line in the middle of, I mean, almost late night. But the same thing if it happens in a stock market scenario. I mean, let's say markets fall 15, 20, 30%. I think you will not have people standing in line, you'll have people standing in line to take out money. Now, the big difference between the last fall and this fall is that every time market has fallen in the last 2 years, for whatever reason, I mean, COVID 1, COVID 2, and we've had a lot of unfortunate reasons, right? We've seen more inflows. So that way, hats off to you, my dear investor, because I think you're doing perfectly the right thing. Now, the most important thing is yes, you put in the money, but if you're expecting something to magically happen to it in 6, 9 months, it doesn't work like that. I mean, if it happens, trust me, you've been very lucky. So equity is a journey which you should keep. It's like a family heirloom. If you've got an investment in a good company or a good mutual fund, you should just forget about it. And that's where real money gets created. Because the power of compounding really kicks in the longer you keep the money. So if you keep churning the money 6, 9, 10, 12 months, you're actually not doing any great justice to yourself. It is in some sense of you going to the racecourse every Saturday and just betting on a horse. You may win one day, you may not win one day. You feel good about it or feel bad about it. But equity is not about that. I mean, and especially index funds and funds like the Nifty, Tiara, etc. They're great products. You should keep some money there. But again, I go back to the old rule. I mean, don't invest in small cap for the short term. Don't invest if you have less than a 5 year period. So if you think that hey, I could need this money in the next 3, 4 years, uh, don't put that money in, and definitely don't borrow to it. That's my other rule for you. Please, unless you're uh, very even the smartest investors do take leverage. It's a great way to amplify your returns, but it's also a terrible way to actually bring down your capital very quickly. So unless you're very absolutely uh, you know 300% convinced on what you're buying, don't take leverage on. Yeah,
Uh,
sure.
we have a question which is wherein the gentleman is asking, what will be the impact of the Russia crisis on Indian
Oh,
markets?
I think we've seen that already. So last 1 week has shown us. So I think it's a very difficult question because I don't think people are really aware of what is happening on the ground. They're getting I think right now the entire focus of the government is to just get our people back home, especially the students who are stuck. It's really sad that they are suffering at this time. And obviously, I feel bad for the regular Ukrainian civilian who's unfortunately been going through this mess over the last 1 week. Now, if you go back and see, since I'm not mistaken, since the USSR broke up, Russia has gone to war about 5 times. Uh, of course, this is the biggest one of them, but they've gone to war 5 times, including something in 2014 in the Ukraine itself. They've actually deployed forces on the ground. If I take history, if you say history repeats itself, typically this whole thing gets cleared out in about a month or two. Of course, this, as I said, is a different scale of invasion because the previous ones have been not so large. And obviously, the Ukraine of today is a very different state of the Ukraine of 2014. They are much better defended. So, as far as Indian markets are concerned, obviously, one big one for us which will hit us immediately is the oil price. We've seen that Russia contributes to about 10% of the entire oil production in the world. Can it get met by other people? Yes, I think Saudi Arabia, Iran, UAE have enough of surplus capacity to, in case there is a problem, to come up and sort of increase their production. But these things will take time. It's not like a switch on, switch off thing. So my guess is even if Russia is out of the oil system for some time, it will take 3, 6, 9 months for prices to cool down. So obviously, higher oil means higher inflation. Higher inflation means obviously higher prices, maybe lower margins for companies, maybe economy slowing down. But all I can say is that compared to the past, we are much better prepared, either in terms of foreign exchange or in terms of government willingness to look at it. I think the government has set up massive task forces. Everybody's pretty much on guard here, which is a good thing for us because that means that the chances of something really getting busted are much, much lesser. What worries me is that if something had not happened and we were not prepared for it, obviously we were not prepared for what happened last week. I don't think anybody really visualized that in the first week of, let us say, this month, that you would have a full-scale invasion. We thought it's more of, you know, posturing, but obviously people, it just happened. So yeah, there's no point in us, it's, all we can do is pray for the people there, hope that they are safe, and who are our Indian citizens, they get back safely and move on with life, and hopefully this thing gets over quickly. That's what we can do as prayers. As far as our portfolio, I think I keep telling people, if you are underinvested in equity, every time market falls, it's a great correction. India has now gone back to its long-term average. We typically, as an average, been about 18 times of our earnings, and we were slightly higher up in the end of last year, September, October especially. But last 3, 4 months, it's actually come off. So we are actually at a, so one of the, the three things that move prices are for a stock are obviously fundamentals. Most companies that we talk to are reporting very strong fundamentals. People are very positive. People are very confident. Second thing is, of course, liquidity. Obviously, liquidity is taken a bit of a hit because FIs are pulling out. So in some sense, they have moved out. But thanks to you investors, we have a reasonably large domestic pool of money, which is offsetting that. Number three is, of course, sentiment. And sentiment so far has been positive. And I think there is nothing, unless something, the war really goes into a different tangent. I don't think there's anything that will destroy that sentiment. Yeah, so I think what has changed in the last, among these three, is the liquidity. Now, I have seen months where FIs have come in and pumped in a single month 35,000 crore. And it's not too long ago. You can go back and check. I think it was in July 2020. So just by being blind followers of FIs actually is not the right thing to do. So they can come back in as quickly as they went out. India is a very, very liquid market, like I said. So sorry, a very long answer to a good question, but ideally I would say this is something you need to look at your equity portfolio, your total wealth, see what proportion of money is of your wealth or your income or your savings are in equity. If they are less, obviously use these opportunities and you will get some along the way, because this is something that I don't think is going to go away in a hurry. Typically, in past instances like this, it has taken us about a month or 2 months for the world to sort of come back into shape. Maybe it will happen in a month, but what shape it takes after that 31st day, what sort of sanctions continue, what long-term effects are there of the economy, what happens to China, what happens to our relations with Russia is something that is evolving. I don't think anybody can take a stand today. At least I can't take it because I don't have access to that information. So I only say that look at yourself then, see how much risk you are able to take, and then of course divide that risk between large, mid, and small and balanced advantage funds. These are a good set of products that will keep you in equities that also obviously take care of appreciation, also downside protection.
Okay, one common question that we are getting is, what is the expected TER in the small cap index NFO, and how the savings in the TER can give additional benefit in 10 years compared to active funds?
I think that last question is very hypothetical because obviously what people tend to do is they just look at regular TR. Let's say the regular TR in the Axis Nifty TRI will be somewhere between 95 to 100 basis points. And the direct TR will be about 25 to 30 basis points. So that's the first question. The second question, frankly, is very hypothetical because I think there is, as I said, there is enough fund manager ability to give you alpha. Right? So if an advisor is able to sit with you, analyze your finances, give you good recommendations, give you a good set of funds where you can park your money, I think, in fact, he's doing his job, his or her job, right? For which there is a compensation that is required. These are DIY products, right? In some sense, the index funds, or they are more advisory products. As I said, they are a little more specialized. So I think the second question, just don't go by the difference and say, oh, this is 1% and regular is say 150 and I'm saving 50 basis points. But it's also important to try and figure out that they have, a lot of your partner's job is also handling you emotionally. Investments, the easy part is obviously investing. I think the tougher part is to stay invested. And that is where a financial advisor or a partner really helps you. So I don't think, Shoaib, that part of the answer, that part of the question is hypothetical. But yeah, as for your first question, it's, yeah, I answered that number. It's about 9,500 and about 2530. Yeah.
We have one question which is very pertinent to this case, as in my age is 53 and I want a corpus of 40 lakhs for my daughter's marriage after 7 years. Can you suggest in which mutual funds portfolio should I invest?
So I would put a question. I would say somewhere. I think again, my old standard answer. Great, thank you. You're being more specific on a public call. We people are not like that. But yeah, I think a combination of balanced advantage funds, large cap, and focused funds are a good place to look. Since you have a reasonably good time horizon, I think you should try and put it into these two, three buckets and put it. That's what I would do. But yeah, again, as I said, please talk to your financial advisor, your partner. I think this is something that requires a slightly deeper discussion than a 30-second answer by you.
This question you have already addressed, but I think they have already asked. They have again asked. So I'll just ask you that small caps have actually corrected by almost 20% from their peak level. So is this an investment opportunity? Should people look at it as a good
No,
chance
no.
to
So,
invest?
so please don't. Obviously, I think when something corrects, people get very excited and say, "Abhi, prices come down." It's a good way to look at it. I love it because it's very different from how investors used to behave maybe 15, 20 years back, where things go down. Actually, people would actually take out money, which is actually the reverse. But again, as I said, this is. I'm sorry, I'm sounding like a bit of a stuck record here. But please, just I think these are questions that you have to have answers with somebody at a more of an individual level, maybe at and have this separately there. I think just uh, sort of uh, any correction is a good time to put money. Definitely, that fact of life is there. But just because something is down 20% from its peak doesn't make it a great investment opportunity. Yeah, it makes it better than what it was at peak. But my old rules stand. Please have money which you can store away for 5, 7 years. Be prepared for fair amounts of volatility. We've had 2 years of outperformance. So you may get maybe 3, 6, 9 months of underperformance. Don't get hassled by it. Uh, so if you can tick off all those boxes, yes, you should look at investing.
Okay, I think we'll take one more question, sir, because there are
Yes, we
lots of
should. Sure.
questions. Probably
Yes,
100
yes.
more
Let's take
questions are
one
there.
more because no. So we will try and answer that. If you can send us an email, we'll try and answer that to the best of our ability individually to you. But yeah, I don't want to keep the group pending for another 2 minutes more because it's, as I said, you've been very kind. You've taken time off on a holiday. Let me not impose on you. Yeah, sure. Let's take the last one.
So, so this question is if the will the oil price cross 150, and what would be the impact that we would see on the Indian markets?
Ah, I hope it doesn't happen, but it's just a number. Let's be clear about it. I think two things. I think one is obviously we've not had an oil price we've not had a diesel fuel increase for the last month. I think now because of the elections, and I think the last time that the fuel increase happened was I think $85 if I'm not mistaken. I may be wrong. So I think yes, you will see some increase, but yes, I think a large part of our oil price or the price that we pay at the pump is also comprising of taxes, both local and both state and central. So I'm sure the government is very cognizant of the fact that if they suddenly make the price of diesel or petrol suddenly shoot up by 20%, which is what 85 becoming say 100 or whatever or 105, it will create a lot of hardship for a lot of people. So I'm sure there's something that will happen there. My belief, Shoaib, is that if you think oil going to 150, if it happens, yes, it can. It go, of course, it can. I don't know. Many people will forget, but in April 2020, uh, just after the COVID crash happened, oil was actually negative. You remember, Shweta?
Yes.
So people were actually being paid to receive shipments of oil. Instead of they paying for the oil, they were actually being paid to take it because there was an oil glut in those days because of the fact. So now I don't think anybody imagined in January 2020 that oil will become a negative price commodity, right? And I don't think, and can it go to 150? Yes. But what typically tends to happen to any commodities when a price crosses a certain, when it crosses a certain price, new investment starts kicking in. And that automatically, or new production lines get opened up, or new, like I said, you could get OPEC increasing the production a little bit. So if that happens, it might be temporary and it will possibly come down. I think the good thing that's happening in the world today is that now people have realized that you have to be less dependent on oil specifically. So a lot of other alternative fuels are also kicking in, right? I think Maharashtra, for example, has the largest, electric public transportation fleet, right? And this was unthinkable 5 years back, right? Now, obviously, you will say a lot of this is ultimately coming through battery, which is getting electricity from an oil source or from a coal source. But what you're not understanding is over the next 5, 10 years, the our consumption itself will come down. When that happens, then that's a very, so in some sense you could see if oil hits 140, 150, people will try and make some money in the short term. Unfortunately, consumers like you and me will pay it. But is it something that I see happening in 2030? I don't know. I think as and when oil keeps doing this, I think the movement towards non-conventional sources of energy will just accelerate. So life could be very different 5, 7 years from now. So yes, there will be some short-term pain, but this will force us to take different measures, which will make our life hopefully a little better for us and overall the planet too. Because ultimately, oil and is in some sense a dirty fuel. So sorry again, long question to a very good answer, a long answer to a very good question. If oil does go to 150, yes, we will suffer. We will suffer short term. As I said, it will create inflation. Inflation could do a lot of damage to corporates, to us. But is it something that I think will carry on forever? No, I don't. It's something that maybe a quarter, 2 quarters, and then I think it will come back to normal. I hope it doesn't happen. I think right now, I think because there is enough production capacity to sort of meet some part of Russian shortfall if it happens. I'm just right now, I'm an optimist, so I'm just hoping that something great happens this week. Peace talks succeed, people stop fighting, and we get back to the task of rebuilding and then obviously repairing and getting things back to normal. Right? So till then, yes, thank you very much for being on this webinar. You spent an hour with me. Stay safe. I think I'm not sure if you're reading, but we have one more challenge coming up there. There is Omicron 5, which is already in Hong Kong. Yesterday, 36,000 cases, about 80, 90 deaths, which has never happened. So a lot of us are actually relaxing ourselves. My request is, yes, please do that, but please stay safe, take care. I think wearing a mask and just washing our hands are anyway great habits, which one should anyway follow. As long as you can do that, let's do it. And yes, God bless you with a lot of prosperity and have a great holiday ahead. Thank you very, very much. Thank you, sure.
Mutual fund
Thank you.
investments are subject to market risks. Read all scheme related documents carefully.